Welcome to episode 11 of the Blockchain Immersive Podcast. In this video, I'm going to continue where the last video left off, in which we were discussing different chart types in technical analysis. In the previous video, we discussed the line chart, the bar chart, and in this one, we will be discussing the candlestick charts. Okay, so today we're going to cover candlestick charts. And this chart here is the daily chart of Ethereum. Okay, and that means every bar here is 1 day's trading. Now, you'll see that this looks significantly different from the bar chart that we discussed in the previous video. As you can see, it's the bar chart is not as informative as the candlestick chart, which gives you sort of a bigger, broader, and more visual understanding of where the market is. So, although the bar chart is really the oldest chart that modern investors and traders use, the candlestick chart is actually older chronologically and fairly new to the investor and trader of today. When I say fairly new, I'm talking about, decades, not like 2 years or something. It's still fairly new. The bar chart was really the first one that people, and the line chart. So candlestick charts, the advantage of candlesticks is that it gives you a better look at the sentiment of the market. You can see green is clearly up, red is clearly down, but it also has added benefits to it. Now, before we go into those benefits, I will discuss what each bar, the components of each bar. In a normal candlestick, it is using the same data that the bar chart is using, but it clearly references it in a much more visual way. So let's take a look at the typical bars, okay? So this red bar clearly is a down day. The top part is the high of the day. The low part is the low of the day, and you see they're like little dashes. These are called wicks or shadows in the candlestick vocabulary. The top part here, this where the rectangle sort of starts here, that is the opening price for the day. And this bottom part here, not the wick, above the wick here, is the closing price for the day. And that is why this bar is red, because it closed down. Today, this is today's bar. Obviously, this can change by the end of the day, but it has a similar principle, but just a slightly different. Obviously, the top wick and the lower wick, or shadows, are the high and low of the day so far. This bottom part, instead of being the closing price for the day, is actually the opening price of this session. And this top part here is the closing price for the session. But because it's still trading, this is just the current price. So obviously, when you look at a chart like this, you can immediately see the sentiment in this market. You can see where people were sort of struggling. Are the bulls going to win, the ones who wanted to go up, or the bears going to win, they wanted to go down? And that's why you see these long shadows or wicks. And when they're very long like this, especially something like this, that means that this market had come down this far, but then rallied back up, showing that the bulls were decidedly in charge. And, and you'll see that with the other bars as well. As you can see, it's a far more visual presentation. Now, I'm not going to go very deep into candlesticks, but I'm going to show you a couple of the basic patterns that make candlestick charts more versatile and more valuable than simply a normal bar chart. And there are quite a few different patterns that we have here. So let me see if I can find a couple here. Okay, here is one. See these two bars here? Let me just expand that a little. These two bars. You have this bar that closed down, but then you have this one that's closed up and it's an up bar, and it completely encompasses the range from this bar. So this engulfs this. So when you see something like this, this is called a bullish engulfing candle. And usually, not all the time, but usually when you see something like this, that means the trend is about to change. Now, interestingly, here, it's going sideways. There isn't a trend. But then right after the bullish engulfing candle, the market started to go up. And so that gave you a little indication of something that was going to change, like something is going to change in the market. So that's one pattern. We have several different others. Here we have something called the Bullish Harami cross, which this is the cross where we have a down period. And then when we have this cross, what it means, it's almost equidistant, the top, the high from the low. What this means is that the bulls and the bears were sort of struggling. You know, who's going to take supremacy in this market? And it's not a perfect bullish Harami cross because usually it would be just pretty much even, but it's very close, similar to the doji, which is another pattern. When you see something like this, usually it means that there's going to be some type of trend change. And in this case, as we saw this upper pattern here. So it's very interesting to look at candlestick charts because they have patterns that can give you a clue as to what is about to happen. You know, like for example, this little pattern here is showing a potential reversal to the downside. But then we have this bullish engulfing pattern. So you see, this is where it gets a little bit dicey, like, you know, well, which way do I go here? And because you have the bearish information that, you know, you want to go short, but now you have this bullish engulfing pattern, meaning that potentially we're going to be going up. And right now, the market is very much up. So this is why you don't want to use the candlestick charts alone without other indicators. Now, there's another form of candlestick charts which I recommend, and what I use substantially is something called Haikanashi. And the Haikanashi is better at reading the trends overall. Like, for example, look at this normal candlestick chart. You see, we go up, then we have this down day. If anyone was looking at this, they would say, oh, this is the down day. That's a reversal from here. Now we're going to start going down. But obviously we did not. And you're going to see a lot of that here. Like, for example, you see this huge down day in a candle. When you see an up move like this, you might think, wow, this market is now heading up to rebound this move. Well, it did not. But if you looked at just a normal candlestick chart, you wouldn't know this. So Haikanashi, which is a form of candlesticks, which we will click here, smooths out the move. So although you're not getting up-to-date current information, what you are getting is an aggregate showing you, okay, what is the major trend here? Okay, and it'll actually keep you in the market longer. I'm not going to go into the calculations of how they differ because they are different in the way they're calculated, and I will cover that. I will go more in depth in that in my course on technical analysis. But I wanted to show you the difference between normal candlesticks and Haikanashi. And let me do a side-by-side comparison. I'll make this the normal candlestick, and I will share the screen with the Haikanashi. So let me just change this one to Haikanashi. And let me scroll that. There we go. All right, this is the same chart. This is Ethereum, a daily chart. Now notice something here. As we went collapsing down into this move, okay, look what happens. We rebound. That's the one that I just showed you a moment ago. And then we rebound again. And anyone just reading the normal candlestick charts would think that this would be the end of the move. But look what Haikanashi does. It keeps you in pretty much all the way to the bottom. Okay, whereas here you're getting whipsawed, in, out, in, out, in, out. Now look at this uptrend here. We are going up, up, up. We pause for a moment. Again, people might say, oh my God, the market's going to reverse and go down. But look at this. Haikanashi keeps you in pretty much right to the top, and you have this little glitch here. But look at how much smoother Haikanashi is. So you will stay in a trade longer. Whereas here, if you just use this, you would be in and out, and it would not be a very profitable endeavor for you. So let's look at more. Look at this. This is another perfect example. If you use the normal candlestick chart, this move up might scare you. But the thing is that we had a blip here and it just continued to go down. And here we have this blip up. Some people said, okay, that's the end of the down move. You don't have that here. In fact, it completely took that out of the equation. And look at how smooth this came down. And look at this. It came all the way down. But here you got an up day. You got an up day. Confused the market. Whereas Haikanashi kept you in all the way pretty much down into here. Let's see if we have more examples here. Yeah, this is a perfect one too. Now look at this with the normal candlestick chart. You are choppy here. It's up and then down, up and then down. But look at this. It keeps you up more of the move. Goes down, up, down, but it keeps you in longer. Look at how it chops you in, out, in, out, in, out. Where here, you're almost completely in the whole move. You're going to have clearly some of these days, but overall, you're in the move longer. And that is the whole point, because as they say, the trend is your friend, right? So you want to be in the direction of the main trend. So let's look at the current bar today. And today is October 11th, 10:53 a.m. So this is the normal candlestick, and this is today, very big day. Look at the Haikanashi for this day. We still have a bearish sentiment. It's still showing that we have a reversal here. So I'm going to wait this out, right? We're going to wait it out and see who really wins, because remember, this session is still very young. We could have a complete collapse. I mean, yesterday, we had this huge run down. So this could also just be a reaction to that, and then it will continue downward. I mean, this is just a possibility. You would not use this in isolation. You would use this with other tools as well. But I just wanted to show you the different types of candlesticks. And again, I go into the computations in my course on technical analysis, which will be coming out soon. But I just wanted to show you the different charts. So if you're going to use any candlestick chart, I would definitely use the Haikanashi over the traditional candlestick. Okay, now I just want to cover one more candlestick type, and it's really not a different type. It's just a visual difference in trading views. So you have here the normal candles, and then you have hollow candles, and all that is that the hollow candles are the up days. The reds still are the down days. So you see, it just turned the green candles into hollow candles. So it's not a different chart type. It's just a different visual representation of the usual chart, candlestick chart. So, okay, that is it for this video. In the next one, I'm going to cover 4 other chart types that are very interesting and in many ways even more beneficial than the ones that I just showed you, including the Haikanashi, because they keep you in a trade longer, but you would need patience and sort of nerves of steel to be able to use them. But if you use them and you don't let the market bully you out, it can be a very profitable endeavor. And again, I am not a financial analyst. I'm just showing you this information. And that's it. So I will see you in the next podcast.